The Intelligent Investor, written by Benjamin Graham, is one of the most popular books on investing ever written. But is it outdated? Well, what you're about to find out is that this is a book on long-term value investing, and it's really more philosophical rather than technical security analysis. So, The Intelligent Investor. Let's start with an example. What if you're in charge of investing $1 billion worth of cash for a charity? Some charities in the world have billions of dollars of donations. Well, the average annual inflation rate is 2%, which means that if you just hold on to all that cash, 2% of $1 billion is $20 million. You just lost $20 million for your charity because you're a bad investor. Now, consider that with the time value of money. $20 million invested in the S&P 500 over 10 years, assuming an average return of 6% a year, becomes around $36 million. So not only did you lose $20 million, you also lost all future earnings on that $20 million. And now your charity isn't helping the world as much. My point is that investing matters, and getting good at investing matters. Now, can the Intelligent Investor really help us get better at investing anymore? It was written in 1949. That was a really long time ago. Well, let me lay out an example with Jeff Bezos and Amazon. Now, I understand that not everyone likes Bezos, but we can learn from him. Again, investing matters. Jeff Bezos is a great investor. So let me tell you a quick story about Amazon. During the dot-com boom in the late 90s, everybody wanted to start internet companies, and they tried to sell everything on the internet. These companies valued growth over profits. They had billions and billions of dollars of investor money pouring in, and they spent that money on trying to get big fast. And ladies and gentlemen, there is no get rich quick. That's the whole point of the Intelligent Investor. The reason Amazon survived past the dot-com boom was because Jeff Bezos understood the importance of building a company and wealth slowly. While his competitors were offering to sell everything online, these companies' supply chains became too complicated too quickly, and customers were always losing packages and money. It was chaos. Meanwhile, Jeff Bezos and Amazon focused only on selling books early on and making sure they could actually deliver on what they said they would. They slowly built out their infrastructure in Amazon warehouses and established trust with customers. Jeff Bezos advised his employees not to pay attention to Amazon's share price, while many of his competitors had their entire company culture built around the share price. The point is that Jeff Bezos built Amazon with long-term value investing in mind, whereas his competitors were all trying to get rich quick. Most of these companies failed during the dot-com bust of 2000. But Amazon lived to see another day. It's no surprise that Jeff Bezos quotes Benjamin Graham regularly in his interviews. So is Benjamin Graham's Intelligent Investor still applicable today? Of course it is. So let's look at some of the timeless principles that the Intelligent Investor lays out. The first principle is with speculation. Speculation is when you take on more risk than you understand, or more risk than you should, simply because you don't have the facts to back up your decisions. You didn't do your homework. Speculation can be good in that you can get big returns, like with Amazon early. But speculators should be a small percentage of your portfolio. And let's clear something up about speculation with market fluctuations. The concept that one should buy because a stock or market has gone up and one should sell because it has declined is the exact opposite of sound business sense, and it's not going to lead to lasting success on Wall Street. Do not buy stocks because the market went up. Do not sell because the market went down. Stocks become more risky as their prices rise, and less risky, not more, as their prices fall. Never buy a stock immediately after a substantial rise, and never sell a stock immediately after a substantial fall. The true investor is rarely ever forced to sell his shares, and at all other times he is free to disregard the current price. The investor who falls for unjustified market declines transforms his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market price at all, because then he would at least be spared the mental anguish caused him by others' mistakes of judgment. The bottom line is, if you buy a stock simply because its price has been going up, instead of asking whether the underlying value is increasing, you will get burned. That is a certainty. Speculators base their standards of value on market price. Do not be a speculator. Benjamin Graham urges you to invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. When asked what prevents most individual investors from succeeding, Benjamin Graham said the primary cause of failure is that they pay too much attention to what the stock market is doing currently. You cannot predict the behavior of markets, so you have to learn to control your own behavior. What you have to understand is that Wall Street is like a casino. Wall Street is the house. It always prevails in the end. If you gamble, you will lose. People who invest make money for themselves. People who speculate make money for their brokers. Investing, if you do your homework, can be like a casino where you always win in the end, but you gotta put in the work. By putting in the work, you have to start with investing and thinking long-term. To reach your long-term financial goals, you must be sustainably and reliably right. Day trading and stock picking quote unquote systems seemed to work in the 1990s, but they had no chance of prevailing in the long run. Over time, these tactics will get you killed, and here's why. You can recognize patterns. Companies are always going to have things in common just by chance, but unless those factors cause a stock to outperform, you can't use these patterns to predict returns. It is correlation without causation. You have to suppress the urge to gamble. There is no get rich quick. Easy ways to make money in the stock market fade for two reasons: the natural tendency of trends to reverse over time or regress to the mean, and the rapid adoption of stock picking schemes by large numbers of people who pile in and spoil all the fun for those who got there first. The intelligent investor will need considerable willpower to keep from following the crowd. In addition to day trading and getting rich quick, we have to consider growth stocks. These typically have the shiny object next big thing appeal, but obvious prospects for physical growth do not translate into obvious profits for investors. While it seems easy to predict which industry will grow the fastest, that insight has no real value if most other investors are expecting the same thing. By the time everyone decides that a given industry is obviously the best one to invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. In other words, when everyone is doing the same thing, more traders buy one thing, making it less of a bargain and thus reducing their returns. Never be so sure of the next big thing. Remember that .coms tanked in just 1 year. And so who's always telling us what these obvious next big things will be? The quote-unquote financial experts. For a reasonable chance for continued better than average results, the intelligent investor must follow policies that are inherently sound and promising and not popular on Wall Street, because experts frequently go astray with forecasts. Experts are wrong all the time. Did you know that only 30% of mutual funds outperform the S&P 500 index? You pay these experts to manage your money, and they can't beat the index. Why should the intelligent investor believe the so-called experts now? The future will always surprise us, so stay humble on your prediction powers. So now that we understand what speculation is, here is what investing is according to Graham. Investing promises safety of principal and adequate return through analysis. So let's break down what this means. Thoroughly analyze a company before buying stock. Deliberately protect against serious losses. Aspire to adequate, not extraordinary performance. Analysis is dependent on safety, value, and facts. Adequate refers to the amount an investor is able to accept with reasonable intelligence. The amount of return is not based on risk. It is the amount of intelligent effort the investor is willing to put in that determines the amount of return. Benjamin Graham also lays out some rules for buying stocks. The first rule is, of course, diversification. There should be adequate, though not excessive, diversification. The intelligent investor recommends a minimum of 10 different positions and a maximum of 30. Not enough diversification means all your eggs are in one basket, but too much diversification would imply that you're spread too thin and can't actually keep up with research on all of your positions. Each company should have a long record of continuous dividend payment. Today, that's at least 10 years of continuous dividend. And here's why dividends matter. If you had invested $1 in the US stock market in 1900, it would have grown to $200 by the year 2000 without dividends. If you had reinvested all of your dividends, it would have been worth $16,000. So that's why dividends matter. It's also worth noting that high prices of stocks affect dividend yield. And here's why. A stock's yield is the ratio of its cash dividend to the price of one share of common stock. If a company pays a $2 annual dividend when its stock price is $100 a share, then its yield is 2%. So if the stock doubles, the yield becomes 1%. The final rule is with the price. The investor should impose some limit on the price he will pay for a stock in relation to its average earnings. The value of any investment is and always must be a function of the price you pay for it. Even in a booming market, stocks are not worth buying at any price because the profits that companies can earn are finite. So the price investors are willing to pay must also be finite. For example, the Chicago Bulls paid Michael Jordan $34 million, and he brought in a lot of fans and profit. But that doesn't mean the Bulls would have been justified in paying him $3.4 billion. So the share price is only an indicator of when to buy and when you are in a bull market and should think about selling. So those are the 4 rules. It's also important to consider market timing. Attempting to time the market is practically and emotionally impossible. There was a study that if you followed the advice of the best 10% of market timing newsletters, you would have earned a 12% annualized return throughout the 1990s. But if you just invested in the S&P 500 index, you would have had a 16% return. Some of the best hedge funds in the world, with some of the best minds in the world, work 24/7 to try to time the market, and they can hardly figure it out. Over the long term, the intelligent investor cannot try and time the market. So here are some alternatives to market timing: rebalancing your portfolio and dollar cost averaging. Dollar cost averaging refers to putting a fixed amount of money into an investment at regular intervals. For example, if you had invested $12,000 in the S&P 500 index in September 1929, 10 years later, you would have had only $7,000 left. But if you had started with $100 and invested another $100 every single month, then by 1939, your $12,000 would have grown into $15,000. And as an aside, in relation to trying to time the market, it's probably best to ignore financial news. Their job is to get your attention, and the best way to do that is to scare you. If you invest based on what the news advocates, you will wind up emotionally and financially bankrupt. But now we know not to try and time the market. Now let's look into some other traps the average investor can get caught in. First, beware of home bias. Some say to invest in what you know. Investing in what you know can be dangerous because of overconfidence. Insiders often possess the illusion of knowledge, not the real thing. The studies show that people try to invest in the companies they work for, and they often get burned. Next is with initial public offerings. IPOs often have the shiny object appeal. The problem with IPOs is that most of the high returns on IPOs are captured by members of an exclusive private club. The big investment banks, venture capitalists, and fund houses that get shares at the initial price before the stock begins public trading. Many big investors often can't even get any initial shares. There's just not enough to go around. So you can get access to IPOs only after their shares have rocketed above the exclusive initial price. From 1980 to 2001, if you had bought the average IPO at its first public closing price and held for 3 years, you would have underperformed the market by more than 23 percentage points annually. Overall, Benjamin Graham argues that IPOs are imaginary, overpriced, and stupid. Too many IPOs cause the market to crash every time, so stay away from buying IPOs in bull markets. Again, you should only buy a stock if it is a cheap way to own a desirable business. Another thing to beware of is top stocks lists. These types of lists are all over the internet and on financial news networks. There are a few problems with buying from top stocks lists. First, the stock can be overpriced as demand is probably high, so you are paying full price. Also, unusually rapid growth cannot keep up forever. Repetition of this growth achievement is now more difficult. It already grew. So those are a few more things to beware of. It's also worth noting that Warren Buffett was a student of Benjamin Graham. So let's look at some of Warren Buffett's investing principles. He looks for franchise companies with strong consumer brands, easily understood businesses, robust financial health, and near monopolies in their markets. He likes to get a stock right when a scandal or big loss passes over. He often looks for large companies going through a period of unpopularity, whereas small companies run the risk of definitive loss. Warren Buffett wants to see a business that builds from within rather than through acquisitions. These would be called serial acquirers. If a company is constantly buying other companies, that could be a sign that they no longer trust their fundamental products. Also, Warren Buffett does not want to see companies with executives that pay themselves $100 million jackpots. So, as a final review, remember to focus on what you can control. Maintain realistic expectations of your returns. Manage your risk through diversification and rebalancing. Remember to hold stocks for at least 1 year, preferably 5, to limit capital gains tax. Investing is about controlling yourself at your own game, so try not to get caught up in emotions, and don't let excitement get in the way. Successful investors are disciplined and consistent. They think a great deal about what they do and have, but pay very little attention to what the market is doing. Remember to have the courage of your knowledge and experience, and do not let anyone else run your business. You're not right or wrong because the crowd disagrees. You are right because your data and reasoning are right. Daniel Kahneman, the Nobel Prize winning psychologist, found that the pain of financial loss is more than twice as intense as the pleasure of an equivalent gain. Do not take on massive financial risks. The pain of loss is more intense than the pleasure of gain. Investing is uncertainty. To be a good investor, you must believe in a better tomorrow. I told you that The Intelligent Investor is not outdated. If you found something in this video that you think is outdated, please leave a comment. To make this video, I read The Intelligent Investor twice, shared my notes with you, and applied animations. It's a lot of work, so please show your support by liking and subscribing, and thanks for watching.